Welcome everyone to Imperium Forex Educational Webinar. My name is Rob Clayton. In today's session, I shall be talking about traders' psychology. Before we begin, I would like to make a note that any advice is of a general nature only and that your personal circumstances have not been taken into consideration. So let's begin our webinar. Trader psychology. The psychology behind trading in financial markets is the strength that moves the market. A chart is nothing more than a pattern of human emotions. Captured in the moment are the emotions of greed, fear, hope and joy. As an educated trader, you take the advantage of the emotional fears that plague other traders. Should I buy? Should I sell? Should I take profit? Should I take a loss? These are some of the questions that can confuse a trader. Why? No plan, no strategy. So what ends up happening is that you enter the market at the wrong time or at the wrong level. You get the feeling of anxiety as the prices goes against you. Finally, you have no choice but to execute the position and take a loss. So let's reverse that role. How do you feel? Joy? Excitement? Even relieved? But then you cut the trade and take profit too soon due to the recent losses. All of this emotional anguish can be removed by having the right disciplined trading strategy and sticking to it. For most novice traders, it is not the strategy that is losing you money. It's not sticking to your original plan. Develop a trading style to match you, even run a performance log. Draw conclusions after a trading day. Utilize tools and methods within the MetaTrader 4 to improve the trader's style or behavior. Strategy. How to do it. Strategy. Each strategy consists of four main elements. Setup. A specific indicator which issues a signal for action. Trigger. Use a specific indicator that issues a signal to action which activates the strategy. Wait and identify the signal to execute the position. Stop management. The technique we use in order to place the initial stop as we enter the trade, and the technique we use in order to manage the stop order whilst in the trade. Execute technique. Execute technique we use in order to close the whole position or part of the position. Strategy management. The stop loss order should be placed immediately upon entering the trade. It's always a good idea to place your take profit too. In a long trade, stop loss is placed either below the lower daily support level or at the designated level without risking too much capital. In a short trade, stop loss order placed above the upper daily resistance level. So let's look at advanced trading methods and what tools that we would use. Technical indicators. Let's take a look at what kind of signal systems we can use to trade. We have a MACD, which is a moving average convergence divergence oscillator, an ADX, which is an average directional index, and then we have a relative strength index, or also known as an RSI, and a stochastic oscillator. a MACD moving average convergence divergence oscillator. One of the most popular technical indicators used in the market was developed by Gerard and Pill in 1979. The purpose of the MACD indicator is to show changes in the strength, momentum, and direction of the current market. Here is a graph, and you can see here, you can see the histogram, the MACD line, and also the signal line. The MACD turns two trend indicators, one being an EMA, also known as an exponential moving average, into a momentum oscillator. As a result, the MACD offers the best of both worlds, a trend following and momentum indicator. So let's have a look at the MACD's histogram construction. The histogram equals distance between the MACD and the signal line. The MACD fluctuates above and below the zero line as the moving average converges, cross and diverge. Because the MACD is unlimited, it is not particularly useful for identifying overbought and oversold levels. So as you can see with the arrow, as the histogram expands, it is measured between the MACD line and the MACD signal. And here again you can see the top and bottom of the histogram, and you can see it measured in between the MACD line and signal line. So when the histogram expands, it's mainly because it's measuring the line between the MACD red line and the MACD single line, which is blue. And here you can see another example. So let's take a look and see how it actually works. Here is a graph of US dollar against the Japanese yen, the MACD line, the signal line, and the histogram. Now at the beginning, you can see that the market has troughed where the red zero line is. Bullish divergence was the first indication that supported a buy signal. Now when price prints a low and then prints another low, you can see here that the histogram is going up. This is also to be noted as bullish divergence, as the price declines and the signals are actually going against the opposite direction. So it gives you a buy signal eventually when the histogram, as you can see here, cuts through the zero and then starts to increase to the top side, purely for the fact is that the market is rising. Now we've got two signals here. First of all, from the bearish outside range day, after the market topped out around 107.50, you can see here that the histogram also topped out as well on the MACD. And then the market starts to reverse from that high and starts to decline. As you can see, the histogram starts dropping away, giving an indication that it's either time to turn your position around and set out your longs or establish a fresh short position. Now when the market goes through zero, as I've highlighted there, then the market should continue to sell off. Now do note something here. Look what we started to see. The price is dropping down once and then makes a new low. But what was the indicator doing? It was doing the reverse roll. And as you can see, the indicator was increasing to the upside. Once again, bullish divergence. Hence, the market gave you a buy signal 2 days prior to the rally. And the rally started from 100.08. So it gave you at least 2 days opportunity to buy the market once the MACD gave you the signal to buy, once it crossed over that zero level. Then the market rose to 104.32 and then the histogram started to decline from that high, and you can see that when it went through zero, the market gave you a sell signal. And then eventually the market found a base after testing that 100.08 level, and then eventually gave you a buy signal. The ADX indicator. The average directional index, also known as ADX, has a minus direction indicator also, and a plus directional indicator. It represents a group of directional movement indicators that form a trading system developed by J. Wells Wilder. The ADX indicator measures how strong a trend is. The two other elements to the ADX indicator help determine whether the market is trending up or down. They are directional movement, plus DM, and minus directional movement, minus DM. These two elements indicate the trend direction. So when the plus DM is above the minus DM, the trend is up. And of course, when the minus DM is above the plus DM, the trend is down. The graph illustrates the ADX as the thickest line, or blue line. And you can see here that the plus DM is the very fine blue line, and the minus DM is the fine red line, which is bearish. So beginning with, you can see here that the New Zealand dollar against the US dollar began trending once the blue line starts rising from where I've highlighted it from that red line bottom, and you can see here that the blue line, which is the ADX, is rising and starts to confirm that there's a trend in play. And eventually the trend tops out when the market hits around 73.5 and the trend is no longer there. And then if you notice in late December in 2016 that the Kiwi dollar found a base around 68.90, and you can see here the blue line again strengthens off that 13 red line at the bottom here, and you can see that the trend is very, very strong from the ADX, and the market went from 68.90 all the way up to 73.5. Now, when the trend, or the ADX should I say, topped out around 68 on that axle on the right there, you can see that the Kiwi went from 72.80 to 73.5, so another 50 points before the trend started to foul. And you can see here that once the ADX starts to decline, is that there is no trend anymore. So when you're looking at the ADX, you only get a confirmation is when the ADX is rising. If it's going sideways or declining, then that means there is no trend. Here again, you can see that this time the red line bounces through and starts rising once it crossed over 13.25, and then the ADX starts to strengthen. And look what the price did. It sold off from 71.20 down to 68.80. Here is another example using the US dollar against the Canadian. Now, as you can see here, I've drawn a line around that 16 level, because that seems to be where the crossover and also where the ADX seems to find support. You can draw this line on your MT4, and just to give you an indication where the trend starts as a base. So the market's in a downtrend. Do we have confirmation? Yes, we do. You can see here that the market on a 4-hour time frame, the trend was clearly indicated from the minus DI and also from the ADX. Then the trend ended, and you can see here that also we've got some divergence coming through there, because you've got a low and then another low in price, and eventually the market snaps to the upside. But using this indicator just on its own gives you some idea in when the market's trending and when it's not. And you can see here that when the market stopped trending, we saw eventually a turnaround in price. So where does the trend begin? Well, as you can see here, that after the market traded in a sideways pattern, since bouncing off that 127.70 level, is that the market surged quite strongly from 128 up towards 129. And then you can see here the blue line, which is the plus DI, and the ADX starts to strengthen and rises. Hence, we have an uptrend. Now you can see here when the ADX tops out, prices also topped out around 131.20, 30. And then you can see we have a downtrend, and look what the indicator did. The red line, or also known as the minus DI, and the ADX strengthens as the price sells off. And once again, you can see here when the market bottomed out and the trend reversed, purely for the fact that the blue line came through from that 16 level where that red baseline is, and you can see the ADX strengthened, and you can see that dollar Canada went from 128.5 all the way up to nearly 132, and the trend was very, very strong. The Stochastic Oscillator. Now here's a graph of the Australian dollar and using a stochastic oscillator. As a rule, the momentum changes direction before price. Bullish and bearish divergence in the stochastic oscillator can be used to foreshadow reversals. So let's see how it works. You can see here that the market was slowly declining and the indicator didn't quite confirm the sell-off. Hence, the market turned around quite sharply and rallied. You can see here that the oscillator made one high and then made a new high around 77.90, but the indicator was not confirming the rally, or in other terms, was not confirming the rise in price, due to the indicator on the right hand side, as you can see from the arrow, is lower. Hence, we saw a rejection from 77.90 in the Australian dollar in November in 2016, and the market plummeted, and supporting with a sell signal coming through as the blue crosses over the red. And do note here in late December, when the market was challenging the downside at 71.60, you can see that the market was tempting to push lower, but the indicator was actually rising. There you have bullish divergence, and you can see the market went from there and rallied from 71.60 all the way up towards 75.90 before topping out. And you can see here that the indicator went overbought. Now also to note with the stochastic, you can use it like an RSI. With the RSI, it works within the boundaries of 0 to 100, and inside that the RSI has 30 to 70, but the stochastic has 20 to 80. And when the stochastic goes over 80, that indicates that the market is overbought, and you can see here that the market did struggle, and from there eventually sold off. A relative strength index, also known as the RSI. The RSI was developed by Wells Wilder as an oscillator to gauge overbought and oversold levels. The most important thing to understand about an RSI is that a level above 70 indicates a market is overbought, and a level below 30 indicates it is oversold. It can therefore range from 0 to 100. The default look-back period for the RSI is 14, but this can be lowered to increase sensitivity or raised to decrease sensitivity. So if you drop your RSI down towards 7, whether that be in minutes, hours, or day or week, then of course the lower the number is, the more sensitive the RSI will be. On the other hand, if you broaden the number out towards 20, 30, 40 or 50, then you start getting a smoother RSI and decreases sensitivity. One downfall with the RSI is that prices can remain overbought or oversold for a long period of time. So let's have a look. This is a picture, or should I say a graph, of gold. Wilder considered the RSI overbought above 70 and oversold below 30. Therefore, still note that prices can remain overbought or sold for a long period of time, as I mentioned before. So the RSI alone isn't always a great timely tool. So there's your 70 and 30. So as you can see here, when gold started to rally in June 2016, the RSI started to approach that 70 level and indicated the market was getting a little bit overbought there, but didn't quite get to 70. But nevertheless, it spiked up towards 1,316 before dropping down. And then again, after recovering, the market hit the highs around 1,360 before dropping down, and you can see the indicator did hit a high of 70 and then now slowly descends towards that 30 base. But it did have one more look before continuing its decline. Now, from the decline, you can see now in September of 2016 that it went below 30 and the indicator started to rise, and so did price, supporting the fact that the market was oversold and it was starting to climb out of that region. And then from the rally before the spike, you can see that the market did top out around 1,300 and then started in a downtrend. And then when I mentioned about the RSI isn't always a great timely indicator. Now, as you can see, this downtrend, the RSI remained under 30 from around the early stages of November 2016 right up towards the mid-December, around the 21st. So for 6 weeks, it stayed in an oversold territory. So that hence why when you're using this indicator, just be a little bit cautious and don't sell too soon or buy too soon. And there you can see, through that period of time, how it remained oversold for 6 weeks. And then, of course, you can see here the market eventually did recover out of the oversold period and then went back towards the overbought and touched that line at 70 before topping out. And then gold fell from 1,210 and continued to decline. Here is a good example. Prices can remain overbought or oversold for a long period of time, as I mentioned again. This is the S&P 500. So when the market first hit 70, and again in February and March, you can see here the indicator did sell off slightly, but the prices still remained to the high side of the range until we fell and then it hit the 30 line and then staged a recovery. But look at this. The indicator hit the 70, but prices went sideways until we eventually got a sell-off in November. And then the market sharply recovered. So if you were trading from a short side, you may have missed the opportunity. And so because of that, you see now in November towards December, the indicator remained in overbought area as the price went up and continued that way. As you can see here again, it touched 17, it was still going up. And again, it went further in the early stages of this year until we got to a high around 2,400. So for 200 or nearly 300 points, the market remained in overbought territory. So if you're selling into this indicator, be very, very careful, or even buying on the other hand, as sometimes with certain markets, it doesn't work very well. But on the other hand, it did work very well for gold, but not for the S&P 500. So this brings an end to my webinar. Thank you very much for joining me. I hope you find this presentation useful to your trading. So from myself and Imperium Forex, would like to thank you for your attention and joining me to this educational webinar.